I'll answer the question without giving specific trades. Maybe I'll give one. But the sort of, when you're doing commodities, there's three things that you look at. And this is perhaps in the order of difficulty. So the easiest would be looking at some sort of trend following sort of model. And that's what the bulk of CTAs do. And as I said, it works, mainly because there are traders in that market that are there not for speculation, but they got to be there for hedging and things like that, where it creates opportunities, creates stickiness, so you can profit from momentum. So the trade just goes in and maybe it's graduated a bit, but it causes some momentum and you can make some money based upon that. So that's probably the easiest to work out. You do your back test, looks great. I should say that what is really important is the ability to execute. So to go from your statistical model to actually making money is not so easy. So to have excellent execution is half the game. The model's half the game, and execution's the other half. Okay, so that's probably at least the statistical part is the easiest. Execution is a different story. So number two is where you're actually using other types of information. And the type of information I like the best to use is what the term structure of commodity prices actually looks like. So if commodities are backwardated, so that means that the futures price is less than the spot price today. And contango means that the future price is more expensive than it is today. Well, if you're able to go and buy a backwardated commodity, you're kind of ahead of the game because you're buying it cheaper in the future than it is today. Okay, so the spot price has really got to decline. It's got to decline more than the price that you bought it in the futures for you to actually be a loser. So there is like an inherent attractiveness to commodities that are backwardated versus contango. And simple trading strategies based upon that are very successful. So you put the statistical with kind of some of the characteristics of the actual contracts and the term structure. And then the third part is the most difficult, and that is the fundamental analysis of commodities. So what is the inventory? Where is the inventory? Is it the case that there are tankers that are parked outside of New York just waiting to come in to dump the oil? It's incredibly complex. How fast can the production be turned up and turned down? Then you have to do economic forecasting in terms of world activity, in terms of the demand side. It's very, very difficult to do. So, and very expensive to do. So in terms of commodities, in terms of portfolio management, many people just do number one, which is the statistical stuff. Some people mix in other information, and that turns into kind of like long shorts or underweighting, kind of the same thing. As for the fundamental, that's just plain hard to do, and you need a huge research staff to cover the complex. You can get a smaller staff to cover a particular commodity, but it's still pretty difficult to do. So that's how you put it together to do kind of a long-short trade, which is how I translate what you're saying as arbitrage. It's hardly arbitrage. Arbitrage is something that is risk-free, and that just is not available in these markets. Of course, there's many, there are many opportunities for investment today, and I guess when you've got some volatility, and we've got increased volatility now, it simply means that there's going to be increased opportunity.
What was the trade?
Oh, I didn't tell you. Well, one trade that I do like is, I was asked the other day for, I'm on an advisory board for a large investment complex, and to go down the G7. Who do you like? Rank the G7. And I put Canada as number one because their fiscal house is solid. In a commodities situation, they look pretty good. And so they are sensitive to the US, but the US is going to do better than a lot of people expected. So Canada number one, US number two, Germany number three. I won't go all the way down the list, but you know who's at the bottom, Japan and Italy. But France is near the bottom too. So if you're going to do a trade, I like this long German sovereign versus short French. Like, that's a pretty fundamental trade. You look at those two countries and they are so different. Germany is a huge trade surplus, fiscally in a good situation, population proven that they're willing to bite the bullet, right, with no riots or anything like that. And then France, totally different situation. Overextended in terms of social welfare, in terms of the legal system, in terms of the regulations, in terms of the national debt, in terms of the health of the banks. It's just screaming long short. But of course, I don't take any responsibility for investment advice. It's unusual.
Should you disclose that you're Canadian?
Yeah, yes, a conflict of interest. I'm definitely long Canada.